This is Kurt Heisinger, accounting professor at Sierra College and author of Managerial Accounting. This video describes where to start in evaluating the performance specifically of investment centers. I have separate videos that talk about the different types of responsibility centers, and there are primarily three: cost centers, profit centers, and investment centers. Investment centers, that's going to be the focus of this video, are responsible for investments in assets, long-term assets, along with the profits of the organization, or that particular segment, I should say, and also the costs. So they're responsible really for everything within that subunit. So we use the term segment, subunit, and division interchangeably in my videos. So when I say division here, I also mean segment or subunit. We're going to use Game Products. This is an example of an investment, a company that has investment centers. So we're going to use Game Products Inc. as our example, and we'll do that throughout the different videos that talk about the different ways to evaluate investment centers. So we're going to use Game Products Inc. That's what you see right here at the top, and we're looking at the three different segments that Game Products Inc. has. And this is the information for the fiscal year ended December 31st. We have three divisions. We have the sporting goods division, we have the board games division, and we have the computer games division. So this is a decentralized organization that has three separate divisions and has a manager or groups of managers that oversee each of these divisions. They're separate groups. And so what you see here are these segmented income statements. And this is a good starting point. We're going to take it much beyond this in other videos, but this is a good starting point. We'll take a look at the profits that each division generates for the company, and that's what you see here. It's good to start with net income, and you'll notice that the net income for each division, of course, is different, that we're looking, and these are in thousands, by the way, that we're looking at. For the sporting goods division, we're looking at net income of $2,306,000. For the board games division, we're looking at net income of $3,466,000. And for the computer games division, we're looking at net income of $1,577,000. So that's a good starting point. And we can certainly compare net income and look at board games division as being the best performing division of the three. But the problem with that is we don't really compare it to the sales that, in just doing that, in comparing it to we don't really compare it to the sales that are generated by each division. So to further enhance this analysis, we can take a look at the net income amount compared to sales, and that is called the profit margin ratio. We can look at net income and divide it by the sales at the very top. So in looking at this 11.53% here, we calculate that by, just giving you one example, by taking net income of, and these are in thousands again, so 2,306,000, and then divide that by the sales of $20 million. And so again, we have net income of $2,306,000, divide that by the sales of $20 million, and that's going to give us then the profit margin ratio that you see right here of 11.53%. And we can do that for each division. And so again, that is a better way to evaluate each division rather than just looking at net income. And if you do that and compare those percentages, you'll see that the sporting goods division has the highest, by just a little bit over the board games division, has the highest profit margin ratio. So that tells us that they're performing the best using this ratio. There are, however, some limitations to using segmented income and just using segmented income to measure performance for an investment center. Because remember, investment centers are also responsible for investments in long-term assets, and we don't look at that at all if we're just looking at segmented income. All we're looking at is the income statement. So we have a real problem if we're just using the income statement and we have divisions that are unequal in size. We have to then pull in assets, and we'll get to that in a separate video. So larger divisions will generally generate more profits, and when I say larger divisions, we're really talking about assets. Divisions that have a large amount of assets, they should be generating more profit than divisions that have a smaller amount of assets. So we need to take a look at that, and again, in a separate video we talk about the measure called return on investment, and that's where we start to pull assets into the equation and look at how these segments are performing with the assets that they put into place. So using segmented income is a good starting point, but we don't want to stop there. It ignores assets, and we want to pull in assets to see how these divisions are doing. So again, that's in a separate video.